everyone can have a chance just to, why are you here? What are you hoping to learn out of this? We have 10 people and up to 32 might show up. So Jeff, do you want to start us out?
Oh, hi. Yeah, this is Jeff Lawhead. Yeah, I'm a member of the Solidarity Fund, and I just finished training this weekend on cooperative ownership and just trying to learn a little bit more about some of the financing pieces. So this just seemed interesting.
Awesome, thank you. Jeremy? Jeremy Katz, do you want to say a little bit about what you're here?
Hey, thanks, Paul. Yeah, this is Jeremy Katz, and I am excited for this webinar. Anything that Paul and Jason put on is worth my time, so that's why I'm here.
And then there's Kay Christie. We'll go ahead and go to Naveed.
Hi, y'all. Thank you just for hosting this. I'm at home. I'll be doing some yoga poses while I listen to you, so I appreciate that it's a webinar and I can be relaxed here at home.
We'll go. Okay, thanks, Naveed. And Kay Christie, you were back on.
Yeah, I am. Sorry about that. I'm Christensen, formerly with and unemployed right now. But
I don't think we're able to hear you fully. Sorry about that.
okay. Yeah. So, anyways, interested in this.
Sorry about that. Okay, Tim. Rosemary, would you like to go?
Hi, I'm Rosemary Rieger. I'm with the Southeast Center for Cooperative Development in Nashville, Tennessee. We're a new co-op development center, and I'm interested in learning more about financing, non-extractive lending, and other alternatives. So thank you for putting this on.
Thank you, Rosemary. Robert? Okay, what about Will?
Hey, this is Will. I'm kind of here. I hope you can hear me. I'm calling in from Chicago. I heard about this through my social media co-op on social.coop, and I'm interested in alternatives to venture capital for funding ventures in our community.
Awesome. Great. Okay, I think that's it. I can say a little bit about myself. And Jason, do you want to introduce yourself?
Jump in. I'll introduce once we get going.
Okay. So I'm Paul Bindle. I'm with Colorado Solidarity Fund. We are a investment club that's based in Denver, but also with people throughout the state. And we have, as you can see, we're a multilingual, interracial, and cross-class investment club. So we have people from a wide range of backgrounds. We have 69 members at this point, who each contribute $20 to $200 a month. So as an investment club, we can have 99 people or less. So we're still there. But our focus is really on Colorado co-ops, community land trusts, and other solidarity economy organizations. So we've kept it a little bit open, although our primary focus is on co-ops. So Jason and I were talking about this, and we identified that the big need for going through these alternatives and being able to explore them as a club and opening it up to the wider cooperative network in the US is important, just because not all co-ops are in the same place. Specifically in Colorado, our ecosystem is young. We have a big gap. We have agriculture co-ops and electric co-ops who have been here for decades. And then we have some co-ops that started, I would say, during the counterculture movement or later in the 90s. But right now, there's a big boom in our state. And so we have a lot of baby co-ops, and we're trying to figure out ways to support those co-ops, both as members of those co-ops and also as just people committed to alternative economies and less extractive economies. So some of the things that we identified was that startup co-ops for our investment club are requesting greater capital than our club can provide. So we've had requests that are anywhere from 30,000 to 300,000. And like I said, we just started last year, so we haven't been able to pool that much money. We also identified that startup co-ops, another alternative is often to offer shares and preferred shares, but some startup co-ops might not be ready to invest in the legal fees necessary to set up a public offering. And that's just that's always a leap, of course, to raise more money and to put that put that into motion. So the third thing that we have recognized is that some co-ops may be pre-revenue, and they might not be, if we were to offer them a loan, they might be interested, and they would probably benefit more in the long term if they could defer repayment so they don't have to immediately start paying back their loans. And so these are sort of, we've come to the table and we're really interested. We have a loan that we can offer young co-ops or startup co-ops, and we also are willing to participate in shared equity. But we wanted to understand if there were some alternatives that would help us sort of leverage what we do have and benefit our local ecosystem.
Great. Thanks,
Oh,
Paul.
and I just want to say one note. As we go through this webinar, if you have questions, go ahead and just add them to the comments, and I'll be sure that Jason hears them and can address them. So if you have like a clarifying question, we'll do that. But then at the end of the webinar, we'll also have time for specific Q&A, and you'll be able to unmute your mics and ask directly.
Great, thank you. Also, just a reminder that we are going to record this webinar for future viewers, folks who couldn't make it today. I'll circulate the link, and we'll also post it to our blog. So if a friend who couldn't be here wanted to have access, that'll be provided. Oops. All right. The legal fine print. This is for educational purposes. My aim is to share a little bit of information about some financing tools that we've used in practice. Nothing here should be viewed as legal advice. We're also not investment advisors, so can't speak to the appropriateness of any of these tools for any particular circumstance for you or for a company raising money. As always, this information should be considered with a professional before being acted upon. All right, so for those who don't know me, my firm and my background, I run a boutique legal and business consulting firm here in Boulder and Denver. We have an office at Wayfinder Co-op in West Denver and at Industrious in Boulder. We've got clients all over the country. We focus on cooperatives and shared ownership. We have kind of a boutique in the social enterprise and economic democracy sector with clients all over the country. We do everything from ownership, design, formation, financing, general commercial agreements, and employee ownership conversions. We're in lots and lots of different sectors. And we have a team of 6 attorneys, 17 members, diverse backgrounds. We're a majority male law firm. And my colleague Linda and I put on a multi-part series on YouTube on employee ownership conversion. So if that's a topic that's interesting to you, we have an open source video series on the how-to for employee ownership conversions. So before getting into the specifics and examples of alternatives, I thought it would be useful to start out with some of the conventional structures for investing. This is not exhaustive and not intended to be detailed description of how each of these conventional structures work, but it's worth listing them out. And if any of them are new to you, feel free to ask about them. But if you were to log on to E-Trade or any other online platform, you'd have access to these types of products for companies whose stock is publicly traded. Typically, if you're buying stock on E-Trade, you're buying ordinary tradable common stock. You go on and buy a blue chip stock, IBM, Home Depot, ExxonMobil, any of the companies that do business internationally and trade their securities online are usually trading common stock, and their securities are both publicly tradable and freely tradable on platforms if you're buying individual securities. Since the 70s, most investment advisors have been pushing particularly retirement investing into something called a mutual fund, which is a professionally or quote unquote professionally managed portfolio of individual securities, whether those are a combination of debt and or equity. They could also just be specialized equity funds. For instance, if you're trading large cap stocks in a mutual fund, what that means is that the fund is comprised of large capitalized companies, some of the biggest market cap companies on the New York Stock Exchange, London Stock Exchange, or NASDAQ. And that would comprise a portfolio. That portfolio would be a mutual fund, and you, me, or a mother or father could buy into that fund. So you're not actually buying shares in the underlying companies, you're buying shares in a fund, and that fund itself is a portfolio of other securities. Some of those funds are managed and they freely buy and sell the constituent securities. Others will just create a portfolio and a balance of securities, and it's more or less unmanaged. Another advent is the exchange traded fund, which is to, as you can see, kind of get further and further from buying individual securities and more or less buy into an existing well-balanced portfolio. An exchange traded fund is like a mutual fund. It's a portfolio, but rather than having a thematic composition, it's designed to simulate an exchange, whether it's the S&P 500 or a large cap exchange or NASDAQ or New York Stock Exchange. It's to take a representative cross sample of those exchanges and buy a portfolio of securities, the performance of which simulates that exchange. The conventional wisdom nowadays is that no professional money manager is ever really able to beat the market, and the best one can do in directly trading securities themselves is to buy an exchange traded fund and invest for the long term. A bond is a form of debt, and a bond is usually a governmental entity like a city, county, or state or the federal government that floats a security usually in public markets on the strength of its creditworthiness, and its ability to repay or its creditworthiness is actually rated by a third party, whether that's Moody's or Standard & Poor's, and the creditworthiness is determined by letter rating, and that signals the risk associated with buying the bond. So if a city needs to invest in a major capital investment project, they'll float $100 million in bonds. Traders and individual investors, institutional investors can buy those bonds that carry coupon rates, interest rates, and they mature over a period of time. And the interest rate is inversely proportional to the risk based on a Moody's report or Standard & Poor's report. So junk bonds, for instance, have high default rates or are viewed to be high default risk. And as a result, the rates on those bonds tend to be pretty high. Whereas a municipality that has an A+ credit rating, pays all of its bills on time, has a great balanced budget and no material political risk, will typically have an inverse and low rate because it's viewed as low risk. And bonds are often in an exchange traded fund or mutual fund. You'll see them in some other balanced funds known as target funds. This is often the kind of anchor that's carrying the capital preservation portion of a portfolio. And then the equity securities will capture the risk and upside scenario to kind of get ahead. Debt is just a general category. Excluding bonds, a debt security might be issued by a private company for the same purpose as a bond, except that it's floated by a private company, or sorry, not a private company, but a private for-profit company. So if, say, a utility company is constructing a major power plant and they need to come up with $1 billion to build it, like a city would, they'll float debt securities in a public market for investors to purchase. Typically, public debt is also rated by those same rating agencies. It functions a lot like municipal bonds. The last thing is preferred equity, and preferred equity is relatively uncommon in publicly traded securities, but not uncommon. Some companies will offer preferred equity securities. New York Times has a class of preferred equity. There are some funds and issuers that offer preferred equity will target a dividend. There's one called iShares, which is a preferred equity fund that pays a dividend instead of paying capital appreciation. But typically private companies, particularly venture-backed and early-stage startups, are offering preferred equity as a way to raise money for their early-stage venture. And I put it in the conventional category because it's conventional for angel and venture capital. And for private investors, it's the way to buy into a private company. Some of the principles that apply to conventional investing also apply to non-traditional investing, but they're worth mentioning here. And again, I'm not a professional money manager, but these are just sound investment principles that you all are probably already familiar with. One is to create diversification, to invest in a portfolio so that the risk in a portfolio is balanced across that portfolio. And that can include diversification across sectors, geography, types of securities, risk. The categories of diversity matter greatly in constructing a well-balanced portfolio. The risk tolerance should also be commensurate with the need for liquidity and capital preservation in a fund. And so a fund that needs to provide for regular liquidity, i.e. the ability for the fund to pay cash distributions, say an investor needs to leave, or there's a regular liquidity requirement imposed by law, or a fund, or maybe even the objective of an investment club like ours might be to not generate capital appreciation, but rather to preserve the capital and earn lower, steadier rates of return. And so typically a capital preservation strategy will speak to lower risk. We're not willing to put our principal at risk, and so we'll invest more in debt or debt-like instruments, and as a result, we should be looking for lower risk investment opportunities. The next is prudence, and this is a requirement that an investor exercise prudence by conducting due diligence. What does that mean? It means investigate, review, ask questions, do your homework. That's what diligence means. A conventional portfolio should also be based on the principle of risk being commensurate with return. So like point number 2, a high-risk portfolio will generally be connected to a higher rate of return. You'll sometimes hear of a fund that has something called an internal rate of return, which is an overall aggregate blended rate of return that they expect to provide for their investors. So the club, we might have an internal expected rate of return of 6% a year. Maybe that's crazy, maybe that's not. But in achieving or hoping to achieve a blended rate of return of 6%, we can construct a portfolio that on balance creates a risk profile that will get us to that target, where the portfolio is balanced between high risk, high return, and low risk, low return that more or less models out to create that expected rate of return. But those two things typically flow in tandem. Two last points. Income generation is achieved either through dividends or capital appreciation. Those are the two primary ways that investors earn rate of return on an equity investment. With debt, it's interest payments. But on an income generating investment through equity, it's through dividends or through capital appreciation. Capital appreciation is also capital gains or the growth in the value of the underlying investment. Lastly, one invests with an eye toward liquidity. What does that mean? We invest with the hope that someday the person or the entity into which we've invested will be able to repay our principal as well as a rate of return. And so we can create a portfolio, again, that balances not just risk, but also liquidity. Some investments are highly liquid. A money market account, a CD, something where the investment can be, we can get out of the investment and pull the cash out, while others might be long-term and highly illiquid, like a preferred share in a private company. There may be a 10-year repayment horizon, and so we can create a portfolio that balances those things out. Okay, so what we're after today are to look at some alternatives. Again, this is not exhaustive, but these are 5 of the instruments that we as a firm have started working with, some more than others. And it behooves us as social investors, starting community-driven ventures, to be looking at some of these instruments, because it's as important that we know the basics as the companies that are trying to raise the money. And these are not necessarily interchangeable tools. These are tools as part of a toolbox that will hopefully make us versatile investors that can support community endeavors in ways that don't hamstring the company or extract value from the company before ready to make a distribution. Some of these are more supportive than others, but I'll introduce the construct of each of these and talk about some examples as I go. So convertible debt. Convertible debt is more conventional in venture financing. This is not even necessarily just an impact oriented instrument. This is an instrument used in lots of traditional startups. What is it? It's first and foremost a promissory note. It's a form of debt. It's fancy, but it's a form of debt. And it starts out by giving an investor the terms of a traditional debt investment, meaning there's principal investment with an interest rate tied to that investment. There's a fixed maturity date by which, all else being equal, the note will pay back the principal and interest. But it has some fancy mechanisms in it that create greater flexibility for the company and for the investor. The reason, and before I go into those, I'll give you some of the context for this instrument. The reason this is used in early stage startups is when a company is in the process of proving out its concept, doesn't yet have revenue, and all it has is really the energy from a founder and maybe a prototype, maybe not. The company doesn't really have market value. It really just has an idea. And it involves a ton of work, a lot of legal documentation, and really a shot in the dark for investors in a company to negotiate a value on a company and say, okay, I'll buy 20% of the company for $200,000. And so a convertible note allows the parties to defer or delay having to discuss and negotiate valuation. It starts out with just debt, and it says later on, if the company ever raises money in what's known as a priced round, me, the convertible note holder, I get the benefit of that later value. I get the benefit of those later terms that an investor might negotiate, but we don't have to decide that stuff now. We're just going to keep it simple. Another version of this is called a SAFE, or a simple agreement for future equity. That's a standard quasi-equity instrument used in early stage venture investing that does not involve putting a value on a company. And so what are the conversion mechanisms? Because this note is designed principally to convert into equity. So
Did you say Could you say what the other thing was besides what you just said? You said there were two names or two.
Yeah, there's a SAFE, a simple agreement for future equity, and then the other one is called a KISS, KISS, and I don't remember what that stands for. Keep it simple, stupid, probably, or keep it simple, silly. But I don't think that's what it actually stands for. But these are actual template documents, and they have those names because they follow relatively standard terms. But all three instruments are designed to convert into future equity, but they start out as something else. Part of the reason they start out as debt is because an early stage company stands a 90% chance of failure. Every startup in America faces long odds. 90% of them fail. And so for an early stage investor that's investing in a company that has no revenue and no marketable product, that's pretty risky. And for an investor that's not buying the equity in the company with the associated right to control the company, they need some other protection. And so start as debt offers greater protection. The investor comes in several increments ahead or above the founders if the company fails. So if there's any cash in the bank account, and if this convertible instrument has not converted, that investor gets first dibs on whatever assets the company has. So there's what's known as downside protection in the form of this being a note at the beginning. Now, like I said, this is designed to convert into future equity. Why? Well, if you're buying into a company before it has any real value, typically you want to be able to ride the wave and cash out when this thing becomes $1 billion unicorn, right? Well, if the company has a 90% chance of failure, you get this extra protection in the form of digging ahead of the common shares. But if this thing becomes wildly successful, an early stage investor should be able to get some of that later appreciation. And so there's a couple of mechanisms that make it sweeter for a convertible note holder to capture some of that upside later on. One is, well, let me back up a second. These convertible notes have several tracks. They follow a company in several kind of vectors. One is the company uses the proceeds of the note and it chugs along and it earns revenue and it never raises more money. And the note just ends up maturing and the investor then gets to this optional conversion stage, and I'll touch on that. The second vector is the company fails. Company fails, and like I said, the note holder is protected. They get their dibs on whatever assets the company has ahead of the founders. The third vector is, and I should say there are 4 vectors. The third vector, and this is the one this note was designed for. The third is that the company grows, is successful, and raises more money. That's the hallmark of any Silicon Valley startup. You get some early stage funding, you prove your concept, you then go for your seed series, round of investing, and you try to raise $2 million, and then you're on to your series B, C, D, E, et cetera, et cetera. That's what this note was designed for. And I'll talk about what that entails. The fourth vector is the second to least desirable. It's the one where the company becomes profitable, neither fails nor ever raises money again. And so you're in this no man's land where you never trigger this automatic conversion, but you also are chugging along and you're semi-successful from an investor standpoint. But from a typical or conventional convertible debt investor standpoint, this is the no man's land because you don't really want just simple interest on your investment. What you really want is the appreciation of your investment through preferred shares. So I'm going to tackle that scenario because that's what this instrument was designed for. So company raises
Jason, could you clarify real quick how much, or maybe you will in this example, but how much typically are companies raising at this stage, like whenever they're asking for convertible notes?
I've seen everything from $10,000 to $250,000 or more. So This is typically an early stage investment product before you value the company. And there's no real bright line between a convertible note round and then a seed round, but I think it would be unlikely to see $1 million in convertible notes. That's typically the domain of a seed round, and then Series A is like 5 to 10 million. So let's just say under $1 million, $500,000 as a good kind of $500,000 is like a good middle ground. All right, so the company raises $500,000, and 2 years later, the company has grown. It's now trying to raise $5 million. Investors will come along. They will negotiate a value on the company, and they'll negotiate a series of preferred terms, which, by the way, among us friends, start to extract a lot of value from the founders, from the company, and put the company on a trajectory to grow fast and sell big. But we should understand what this instrument does. So what it does for the convertible note holder, it puts a cap on that valuation. So if the company is in this seed series is valued at, quote, $10 million, what does that valuation mean? The convertible notes might say that the conversion of this debt into equity is capped at 5 million. So rather than get diluted, and we can run through math later, or I can turn you to some other resources to show you this. If a valuation cap is at 5 million, but the future investors are buying in at $10 million in valuation, these convertible note holders have capped their dilution. And there's a very straightforward computation that will show you the amount of shares that one is eligible for at a valuation cap. But that valuation cap will determine the dilutive potential of a later round. The lower the valuation cap, the less dilution a convertible note holder is subject to. Just instill that principle in your mind, and then we can come back to it. The second is a discount rate. When that later qualified financing comes around, there's a price per share. Usually you're buying X% of a company at this much investment. That computes to a price per share. The convertible note holders typically get a discount. They convert at a discount of, say, 75% or 85% of the purchase price. What they end up getting is more shares at the equivalent later value. That's how they get their upside. They get their upside in the form of this discount. Rather than converting at dollar for dollar, they're getting those same shares at a 15% or 20% discount. And that's their upside.
And ideally, that wouldn't hurt the business, or wouldn't, because the business is growing and is more profitable. So
it hurts the founders. It doesn't hurt the business. It hurts the founders because they're diluting themselves for every share they issue and sell to future investors and to the convertible notes that convert. And this is the most extractive trajectory that founders can be on, is to go through typical venture financing that has convertibles to seed series. They're just stacking on investors who are going to get paid out before them. So this is highly dilutive to founders, but to the company, all of this speaks to the need to grow. So convertible debt may or may not be a great strategy for the fund, but it's one of the tools in the toolbox. All of these terms contemplate this qualified financing. A qualified financing is the effort the company goes through to raise capital, raise new capital, and there's a threshold. Usually there's a threshold that's defined as 10 times the amount of money raised in the convertible round. That's determined to be the qualified financing. That's what's defined as the next round of funding that converts the debt into equity automatically. The last piece of convertible debt is this optional conversion. I'm going to breeze through this because it is rarely happens, but it's part of the terms. If no qualified financing has taken place and the company's not bankrupt, then there's usually a provision that allows the convertible note holder to choose to either get out at maturity or to convert into common stock. They can kind of pick and choose. But because there's no priced round for preferred stock, the terms are optional, and they give the investor the right to determine whether to just hold on to a note and preserve their downside protection, or to convert it to common stock and hope that the company grows later and provides some liquidity. And they would do that if they didn't want to hold debt, they want the accrued interest, and they just wanted to ride out the long-term prospects of the company. I'm going to move a little bit faster since I found myself a little bit behind. So this one is more exciting and potentially more meaningful and germane for us, the club. This is a revenue share. The revenue share is a family of instruments that generally correlate the return on investment to revenue or profit rather than on liquidity. What I just described earlier, the convertible note contemplates fast growth and a liquidity event. Revenue share is a type of instrument that pays back the principal and return based on the organic revenue generating capacity of the business. This is viewed to be non-extractive because it's not, if the return is not paid out from later investors or from an IPO or from a big cash out event. It's paid out based on the sustained profitability of the business, but without imposing a fixed debt repayment schedule. And so revenue share is a family of instruments. It's also known, one of the most prevalent forms is known as a demand dividend. The demand dividend is a template standard form of investing. It has its own term sheet. You can read about it. It's designed to be non-extractive. Typically, a demand dividend will put an cap on the return for an investor. So if you invest $100,000, the terms will cap the return at $300,000 or $400,000 with a multiple. It starts out, what makes it non-extractive, what makes it company friendly is it starts out by putting a holiday or dividend in place before which the company is obligated to start accruing dividends. The theory is for an early stage company, they are just getting off the ground, and it would, as is typical for debt investments, it would be harmful to the company to impose interest accrual or repayment obligations before it's actually generating any cash. That just becomes an accrued liability. So the demand dividend will start out with a holiday either for a certain period of time or until the company hits certain revenue or profitability targets. The next thing it does is it defines free cash flow or net available cash flow to more or less determine what the pool of available cash is that allows the company to healthfully operate, pay its bills, build its reserves, invest in its future growth, pay its employees well, and define what's left over. What's left over is the pool from which these dividends will start to accrue and be paid. The next period is this dividend accrual period. Unlike debt, the dividend is accrued either on the books of the company, which is advantageous for the investor because they're not taxed until they're paid, but they accrue on the books of the company. And then finally, this instrument has a dividend redemption and repayment period where once the dividends have accrued up to this cap, the company begins to actually start paying down this investment over time. And that timeline can be negotiated, stretched out, or shortened. But the demand dividend is a great term sheet to start looking at and getting comfortable with. And all these are pretty flexible in how they're defined and how they suit the company. The next one is a concept, more so than an actual set of terms. This is a concept called catalytic first loss capital, and it's a family of investing strategies that don't necessarily target investment returns first. It actually targets the target is leverage the ability
Excuse
for
me,
a company
Jason.
to.
1 second. Jeremy had a question about rev share, if that's okay.
Oh yeah, how does a business owner make a business decision between investing in growth and repaying angel investors? Typically, this is what's hammered out in the negotiation, and depending on the structure, in this example of a revenue share, every element of how this net excess cash flow definition is laid out will determine how the business can reinvest in growth and in the future. But what's delineated as net excess cash flow, everything is set out so that there's no tension or uncertainty between the investor and the company. The investor knows her target return. It's capped. You know that you're eligible to receive up to a 3, 4, 5x return. And through this schedule, dividend holiday, dividend accrual, dividend redemption, you also know your timeline. Now that's an ideal time, but the net excess cash flow calculation puts in place the safeguards that allow you to know, you the investor to know how the company is going to meet its obligations, grow, and accrue the dividend in a way that allows them to actually make cash payments to you over time. But you're ironing all these details out up front. So there's no uncertainty, or there's little uncertainty as the company's operating and generating cash. Jeremy looks satisfied. All right, so this catalytic cost capital, again, the concept to incentivize other investors to join us and invest. So this is part of a combination of getting the first tranche of capital in so that other investors will come in somewhere else in the capital stack.
Could you explain what tranche means, just for people who might not know that
tranche
word?
Is sliver or grouping. So if you think of a company trying to raise $1 million, a tranche of that million or a grouping of that million might come from this catalytic first loss. Maybe that's 100,000. Another tranche or grouping might come from the 900,000 in other investor dollars. So the way it typically works, a party decides to bear a certain amount of the first loss. And I'll talk about how they can do that. That first loss taker comes in and acts as an insurance buffer, either in the form of equity or debt. By acting as that first loss or first risk capital, they make it safer. They, quote, de-risk the investment for market rate investors to participate on more traditional terms. So if you think of a social impact company that isn't quite competitive for market rate returns, you might find a foundation, place-based foundation, or social impact investor that's willing to put their investment at first loss so that the risk on the overall rest of that investment is lower, so that they can justify a lower rate of return for the market rate investors. You can do it on the debt side or the equity side. On the debt side, this might be in the form of somebody taking junior unsecured debt that pays out, or that's the last to be repaid. And if it's a debt offering, you might pair this with something known as mezzanine or more senior debt. The more senior debt in this debt repayment order would get paid back first. This first loss capital is maybe a higher interest rate for this higher risk, but they're the last ones to get paid out. If you're a foundation, you might actually be willing to do this at lower interest. And that's what makes it catalytic, and that's what makes it community oriented. Someone's willing to take the risk first and hopefully willing to take a lower rate, so that this other debt capital is willing to come in and view the whole thing as less risky. On the equity side, you might get that same impact investor or foundation to buy common stock so that preferred investors are willing to come in. They see that someone is injecting, say, $100,000, and what they're buying is not preferred dilutive stock. They're buying common stock. They're buying stock of the class that is the last one to ever get repaid. And its purpose might be to incentivize $900,000 of more market rate investment for an otherwise less financeable company. What it's doing is creating a distribution waterfall to protect these senior investors. And that's what makes it catalytic. It sparks, it incentivizes other investors to join the mix. And so what we're designing here is that baseline low level of capital that either takes the first loss in default or is the first risk to lose money if things go belly up. Here's an illustration. The GIN is a global impact investing network, has written about this, and the way that the catalytic first loss investment can be made is by, again, equity position that can be in the form of common shares. Sometimes foundations will make grant investments into for-profit companies. That can be the first loss capital. The grant is, it's a giveaway. There's no expectation of a return on that or repayment of that money. That can be the catalytic first loss. A guarantee, I'm going to talk about a guarantee in a second. That can also create the first loss pool. And then I mentioned subordinated debt. Junior unsecured debt, is the last in the waterfall, even if it's the first money in. All right, I have just a few more comments, and then hopefully we'll have about 8 minutes for Q&A here. The last one is a social impact bond. This one is both a product and a concept. There's a group in Cambridge, Massachusetts called Transformation or Transform Finance. It's not the Transform Finance of New York. It's a different organization that does and develops social impact bonds. But this is I'll talk about what it is first and then how it's structured. It's typically a bond that has no fixed rate of return. Its purpose is to connect and incentivize investment by investors, service providers, and what are known as outcome payers. These are usually public entities, like governmental entities, that would otherwise be paying for certain outcomes, like health improvement outcomes, or education, or poverty reduction, harm reduction, affordable housing starts, or sheltering for homeless populations, et cetera. The product, the social impact bond, incentivizes progress for these outcomes, and it incentivizes these constituencies to accomplish clearly defined outcomes in a way that incentivizes investors to put in first capital. It incentivizes investors to put in the capital because there's a stream of income from the outcome payer. The government might pay into the bond, which becomes the pool that pays the investors back for every outcome that this business or that this issuer achieves. So if you think of call it an affordable housing entity that brings in a public housing authority to pay $100,000 for every new unit of affordable housing, the affordable housing construction will require $10 million in upfront capital. Will come from investors, and for every unit constructed, the Denver Housing Authority will pay $100,000 back to the development company that's issued the bond. That $100,000 will, maybe pay $30,000 to its overhead, with $70,000 going into the pool to pay investors back. And if you can imagine a certain scale, they might achieve enough social impact payments to generate a rate of return for these investors. So here's kind of the ecosystem. They're the service providers that are providing the service they're providing the service for which the outcome payer is paying, capitalized by the impact investors, and these are generally done through public-private partnerships. You can think of the social impact bond as a capital tool to extend the reach of public entities, public agencies. I think with opportunity zones and with tax credits, these could be potentially viable options for us, the fund, to be putting money in to find social impact bonds in our communities, to find those agencies and entities that are doing the actual on-the-ground development work that need the upfront capital and are connected to outcome payers. But they're, like I said, they're underwriters that are helping to construct these things they're a little, I don't see us, the fund, as assembling and putting one of these together, but we might see ourselves in the impact investor circle. But that work, we obviously are connected to the service providers and to the outcome payers. The last topic that I'll cover before we get to the Q&A is a third-party guarantee. This is a product by which we, the impact investors, put up no actual cash. We don't write a check. But what we do is provide a guarantee to cover a certain amount of loss. So if a co-op were to come to us and say, hey, we want to get a $100,000 line of credit from a credit union, but none of our members can afford to make a personal guarantee or is willing to give a personal guarantee, we, the fund, might be willing to say, we'll put $30,000 of our, we'll put $30,000 to cover a default on your line of credit. What this does is it enhances that co-op's creditworthiness so that a bank is willing to make a loan or private lender is willing to extend credit or make a debt investment. It reduces the cost of senior debt capital by, again, de-risking the underwriting. And we only pay if the business defaults. We have leveraged our balance sheet for the benefit of that borrower. We become a partial guarantor. Now, this could be something that we do for co-ops in two ways. One, we could offer this to co-ops so that they can get bank financing, lines of credit, et cetera. Or we can offer this to members in co-ops when it comes to their buy-ins in the co-op. They might take out a loan from their co-op. If it's a $5,000 buy-in, and this is a co-op for low-income earners, and they can't buy in, we might offer a guarantee so that, you know, if that worker owner falls on hard times and is struggling to make payments on their buy-in, this is an arrangement whereby we step in to pay for that pay a portion of that member's buy-in while they're in default. And so this can be a buffer. All right, I've eaten into too much of my time allotted, and I want to make sure that we have a little time for discussion. I can probably go a few minutes over here, but that wraps up what I had in mind. So I'll stop there and see what questions and topics folks want to discuss. Thanks for sticking through that.
I'll be hopping over to my other computer because my time is running out at the library. So 1 second.
All right, while you're moving, I can happily moderate here. And folks can feel free to unmute themselves, and no need to announce, just chime in with any comments or questions or remarks, anything.
I guess I'm curious, like, which of these 5 tools that you've brought to our attention seems the most feasible or easy to implement?
I think the demand dividend is really exciting. As, again, a family of investors that supports. Hey, Paul, I'm going to mute you. There's a little bit of feedback.
It should be good now.
Okay. The demand dividend, I think, is exciting. It supports a company in its early stage or a co-op in its early stage. It doesn't impose any strict requirements on the company's corporate structure. It can be done in any type of entity, really. And you're not diluting the company's founders. You're just really agreeing upon a reasonable rate of return through the use of reasonable reserves. And so you can really co-design what that map has to like for us and for our company. And how that gets sorted out is really easy. The last comment I'll make is no matter what sort of investing we do in our community, we need to understand that by virtue of us being a club and by virtue of our members not being accredited investors, there will always be a little bit of a hurdle for companies to fulfill their legal obligation to disclose information to us. And so there's always going to be a transaction cost, but I think in terms of the financial terms, aligning our objectives for community involvement and engagement and support through non-extraction to help a company start and build itself up, I think the demand dividend is the most exciting, as is the guarantee, because the guarantee actually might not even require the level of documentation and disclosure that a traditional investment would. So I think those two things are probably the most exciting to me.
Hey, Jason, this is Jeff. I'm curious, is that ostensibly a royalty payment, what you're referring to?
It's also known as a royalty payment. Yep.
Okay. All right. Yeah. Okay.
Some know it as a royalty payment. I will say it can actually be structured as either an equity or debt instrument, but it is a royalty, revenue share, profit share, any of those things. They all fall within the same family. Great point. There's a question on the chat. What's the best vehicle for investing in a local micro business, like a sole owner or operating business? I think the objective there would have to be to reduce and avoid as much as possible legal cost, legal complexity, documentation complexity. We're just looking at getting capital into a local micro business. I would think that it should be done in the form of a secured loan. If the loan is secured by sufficient collateral, that is an asset that can be in default sold with the proceeds going to pay the balance of a note, that is what ultimately simplifies the documentation requirements on the company. Whether we like it or not, state and federal law puts a significant burden of documentation on the entity raising money. We have to be in a position that imposes a high disclosure obligation on the companies we invest in. That's not our fault. That's just the status of the law. So the way around that is to invest in something that is exempt from those documentation requirements. The safest thing, without going into the details, is a loan backed by sufficient collateral. There's a question here. Can you talk briefly about the tax implications for each of these, including for the founders, business entrepreneurs? That's a little complicated. Probably outside of this call, I think they each do have some complexity in terms of the recognized tax implications for the investor and the potential tax consequences for a business and for founders. You raise a good point. There are tax implications, but that involves, I think, a level of complexity that we don't have time for here today.
We might be able to say briefly that the way the club is structured, we've tried to make it a pass-through entity so that members bear their shares of the dividends on their own taxes. So that's one aspect of the tax, but of course there's many more. So
yeah, that's a great point. So to put a little bit of context, if you're not already familiar, the way the club is set up as an LLC taxed as a partnership, for every dollar of income that exceeds our expenses or capital gains that exceeds any deductions, that taxable income or gain is allocated to the members. The LLC club pays no income or capital gains tax. That's all paid by us. Likewise, if we bear a share of loss, that's also carried at the individual level. Great point, thanks.
And many co-ops are structured with a pass-through structure as well. So I think that's also relevant. It's very similar. But anyway, that's still going in way high above my pay grade. So
We've got another minute or two if there are any other final questions or comments. I'm also open to doing more of these lunch and learns. There are other topics that we want to explore, anything that is kind of in our wheelhouse. More than happy to schedule these out. I have been remiss in not being able to attend as many of the in-person get-togethers. So in a prior conversation with Paul, this came up as one way that I can contribute back to our investment club community. So if there are other topics, I'd be more than happy to do more of these in the coming months, if they're helpful.
Yeah, no, this is great. Thank you.
I think it would be interesting if people have just a second to write something down. Like, what is one thing that you're taking away from this webinar? It would be really helpful to know your big takeaway or something that stuck out to you that you didn't know before. Would you be willing to write that in the comments or maybe just say that briefly?
Sure.
Yeah, feel free to popcorn.
Go ahead, Jeff. Pop in. Popcorn is fine.
Oh, no, I mean, like I said, I mean, we're still, I think, trying to figure things out. In other words, we just, as we, for those not in the club, we just made our first investment for $10,000, 5,000 equity, 5,000 debt. But we're starting to see a lot more deal flow, it seems like.
I think what I'm taking away from this is just that we have a few more tools in our toolkit if we want to take a step toward something. So I know co-ops have come to us, community land trusts have come to us, and for whatever reason, there's been some hesitancy about the loan process. And so I think having a few different tools will help us navigate those conversations and also hopefully help our members understand, how our money might be able to be leveraged. So.
Great. Jeremy writes, I think the demand dividend is most interesting as a non-extractive financing option. Curious about how complex it is to set up. That's a great bit of feedback. One thing we might do as just an idea, we might actually download the sample term sheet, study it as homework, and discuss it at a meeting. And I might be able to either get there, I can try to get there remotely if that would be of help. And then Robert writes, thanks for putting that on our radar, that the demand dividend makes sense for organic returns and the ease of debt for micro enterprises. I'll make one comment. There's another resource online known as the Impact Terms Project. It's focused on institutional impact investors, so it may not apply for micro enterprise or community investing. But again, these are concepts. These can be mixed and matched, so we don't need to think of these things as rigid formalities. We can really think about blending. And if we have the patience and the ability to tailor the documentation, we can do a lot. So I encourage us to just draw mostly inspiration and creativity from these models, not necessarily to think of them as products.
I have one question real quick. Just if I am like a co-op or a small business trying to use one of these methods, what is the biggest single lever that I can pull to get ready or to prepare for investment?
It's a great question. At the highest level, a written business plan with a financial model. And what I mean by that is business plan, and I think written in paper or written down, something that shows me, a contributor, a supporter, that you've thought through the structure for your business, how its operations will function, how it will earn money, what it needs money for, how it, what its kind of competitive environment looks like, and how much it needs to raise. There's, a financial model can have lots of components, but one is it shows mastery of how dollars flow through the co-op so that it can generate surplus from which to pay my money back, maybe with a rate of return. If nothing else, a financial analysis, but hopefully a business plan. I can't underscore how important that is for any type of investor. It would make our job easier to consider an investment if we had that and could look at it and ask questions based on that business plan. Because and if done well, it actually answers your questions before you know you even have them. All right, I've got to run, so hopefully this was useful but feel free to tap me offline and send feedback about what other sessions might be interesting, and I'll look forward to seeing you all online and hopefully in person.
Great, thanks, Jason.
Thank you, Jason. I wanted to point out one more thing that Robert Burnett wrote, that a commons model is regenerativefootprint.org. So he just wanted to bring out a different website. So if people are interested, it's regenerativefootprint.org. Thank you again, Jason, and thank you for everyone who attended. We appreciate your time and look forward to sharing this with the broader community.
Thanks, Paul.
Thank you, Paul.
Bye.
Everyone.